Hi guys! Welcome to the Ancient Monkey YouTube channel. So before we get started, make sure to hit that like button, also subscribe to my channel. In this video, we will talk about what's the difference between bonds and stocks. So make sure to watch the full video. What are stocks? Stocks are investments directly in companies. When you buy a company's stock, you buy a share of the company. You literally own a piece of the business. That means that as the publicly traded value of the business increases, your share of that value goes up. Conversely, if the value declines, the value of your stock will go down. If the business makes a big profit and decides to give some of that money to its owners, you'll receive a dividend. What are bonds? Bonds are an investment in debt. Bonds are a way for companies and governments to raise money. They're essentially small loans you make to large entities. For example, if a city wants money for a park, it can sell bonds now and pay buyers back with interest later. You give the city the money it needs, usually just a portion of it, and over time it will pay you back with interest. You could choose to hold on to the bond and get your money back over time, or sell it early to someone else. Stocks versus bonds. What are the pros and cons of stocks versus bonds? And should you invest more in stocks or bonds? Let's look at how each works. Stocks. If you're looking for the chance to earn a higher return, you'll probably want to consider stocks. But with the potential of more return comes more risk. Stocks fluctuate along with markets. Say you bought $1,000 worth of stock in a small tech company that sells products online. Let's call it Rainforest. Over the next 15 years, Rainforest becomes a household name that does billions of dollars worth of business each year. The value of its stock increased 100 times. You could sell your stock and walk away with $100,000. However, it's also possible that the stock price could drop below what you paid, or that the company you invest in will go bankrupt in a year and you'll walk away with nothing. Bonds. Bonds issued by the U.S. federal government and bonds labeled investment grade are generally stable investments. They pay steady interest over time, also called coupon payments, and the entities are unlikely to go away before the maturity date or date when the debt plus interest must be paid. Say you buy $1,000 in bonds from a major corporation. The company agrees to pay you 4% yearly interest over 10 years. Unless the company goes bankrupt or runs into serious financial trouble, it's likely that you will receive exactly what the company promised and walk away with $1,400 10 years later. But because bonds tend to be safer, you won't have the opportunity to reap a high return as you would with stocks. Unlike stocks, bonds are a debt the company owes to you rather than an investment, so the interest and value of the bond is not tied to the stock market value of the company. The price of bonds also goes in the opposite direction of interest rates. So, if interest rates go up, you will be able to sell your bonds for less. For example, a $1,000 bond might go for $900. Because investors can purchase new bonds with higher interest rates. How is a bond different from a stock? Bonds are investments in debt, while stocks are a way to purchase part of a company. Stocks and bonds also offer different risk levels and returns on investment. Let's look at the pros and cons of investing in each. Pros and cons of stocks. Stocks can be high-reward investments, given that they have the potential to result in large returns over a long period of time. They tend to grow with the economy and can help stay ahead of inflation. Because stocks are higher risk, it's easier to lose money, especially if you're investing in individual stocks. Pros and cons of bonds. Overall, bonds tend to be lower risk investments than stocks, and often they offer a higher interest rate than you could get by putting your money in the bank. The drawback is that they are low reward, and interest payments may only keep up with inflation. They are also often more expensive than stocks, as most bonds are sold in increments of $1,000, so there is a higher barrier to entry. Lower-rated bonds, like junk bonds, run the risk of default. Investing in stocks and bonds. Ultimately, the best investing strategies use a mix of stocks and bonds, and sometimes alternatives like cash, commodities, or real estate, to balance risk and opportunity for reward. And you don't have to invest directly in individual stocks and bonds. You can also buy funds like mutual funds or exchange-traded funds that invest money in a wide variety of stocks, bonds, and alternatives for you. If you are closer to retirement, you'll typically want a larger percentage of your portfolio in stable assets like bonds. Talk to a financial advisor to make sure you're on track for retirement. Stocks and bonds are two common types of investments. Stocks represent an ownership stake in a company. Bonds are debt. They are two different ways companies fund and expand operations. Let's see what that means for you, the investor. Stocks represent ownership. Stocks are simply ownership shares of corporations. When a company issues stock, it is selling a piece of itself in exchange for cash. Suppose a corporation makes it through the startup phase and becomes successful. The owners wish to expand, but they are unable to do so solely through the income they earn through their operations. As a result, they turn to the capital markets for additional money. One way to do this is to split the company into shares. Then, they can sell a portion of these shares on the open market in a process known as an initial public offering, or IPO. Bonds represent debt. Bonds, on the other hand, are debt. When an entity issues a bond, it is issuing debt with a promise to pay interest for the use of the money. Each bond has a certain par value, say $1,000, and pays a coupon to investors. For instance, a $1,000 bond with a 4% coupon would pay $20 to the investor twice per year, $40 annually, until it matures. After it matures, the investor is returned the full amount of their original principal. If, for some reason, the issuer is not able to make the payment, the bond will default. This rarely happens. The difference for investors. Each share of stock represents an ownership stake in a corporation. That means the owner shares in the profits and losses of the company, although they are not responsible for its liabilities. Someone who invests in the stock can benefit if the company performs very well and its value increases over time. At the same time, they run the risk that the company could perform poorly and the stock price could fall. In the worst-case scenario, the company may file for bankruptcy and even disappear altogether. Bonds lack the powerful long-term return potential of stocks, but they are preferred by investors who want to increase their income. They also are less risky than stocks, while their prices fluctuate in the market, sometimes quite substantially in the case of higher-risk market segments. The vast majority of bonds tend to pay back the full amount of principal at maturity, and there is much less risk of loss than there is with stocks. Which is right for you? Many people invest in both stocks and bonds to diversify. Deciding on the appropriate mix of stocks and bonds in your portfolio is a function of your time horizon, tolerance for risk, and investment objectives. Typically, stocks and bonds do not fluctuate at the same time. If seeing a stock price fall quickly would cause you to panic, or if you are close to retiring and may need the money soon, then a mix with more bonds could be the better option for you. If you're a young investor who has a lot of time, you can benefit in a weak market. You can buy stocks after their prices drop and sell them when their prices increase again. Each person has their own financial goals. Try to keep them in mind when choosing which investments to make. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.